Imagine discovering you've been overpaying your U.S. taxes for years, or that there's a straightforward, completely legal path to significantly reduce your future tax bill.
Yeah,
For non-resident aliens, navigating the complexities of U.S. tax forms can honestly feel like, well, like deciphering a secret code, right?
it really can.
But what if we told you that within the very instructions for these forms lies specific, often overlooked strategies and, profound differences that could put a substantial amount of money back in your pocket?
That's exactly it. That's the core mission of today's deep dive. We're here to empower you, our listener, with essential, actionable insights directly from the 2024 instructions for Form 1040-NR.
The U.S. non-resident alien income tax return.
Precisely. We're going to, cut through the jargon, pinpoint the critical distinctions from typical U.S. resident returns, and really eliminate crucial tax-saving opportunities that are often missed.
Like tax treaties.
Exactly, like the power of tax treaties, specific elections you can make. Our goal is simple. Guide you to resources designed to help you avoid overpayment and ensure you pay precisely what you owe, not a dollar more.
Okay, let's unpack this then. Our mission today, demystify the U.S. tax landscape specifically for non-resident aliens. Starting with the foundation, Form 1040-NR itself.
Indeed. Form 1040-NR isn't just another tax form. It's the specific, distinct U.S. income tax return designated only for non-resident aliens.
Right.
Think of it as a completely different pathway compared to the more commonly known Forms 1040 and 1040-SR, which U.S. citizens and residents use.
So different rules apply.
Completely different rules. While you'll recognize some similarities in the types of income or deductions you might report, the actual layout and, more importantly, the underlying rules are fundamentally different.
Okay.
These distinctions aren't just minor clerical differences. They critically impact your overall U.S. tax liability, often in surprising ways. It's not simply a different number on the form. It's a unique set of rules tailored to specific international situations.
So it's definitely not just a simple swap then. What kind of additional paperwork are we talking about here? Because that's often where the complexity really ramps up, right? Just getting the right forms.
Precisely. You'll always need to complete and include Schedule OI. That's Schedule OI with your Form 1040-NR.
Always.
Always. This schedule is crucial because it gathers other information that's absolutely vital for establishing and verifying your non-resident alien status. Details about your entry into the U.S., your visa type, things like that.
Got it. It's the background check, basically.
It's the IRS's way of understanding your specific international situation, yeah. Beyond that, depending on your individual circumstances, you might need a whole host of other schedules.
Like what?
For instance, Schedule 1 is for additional income or adjustments to income, like certain capital gains or adjustments for IRA contributions if you qualify.
Okay.
Schedule 2 covers additional taxes, maybe alternative minimum tax or excess advanced premium tax credit repayment, things like that. Schedule 3 is for additional credits and payments that don't fit directly on the main form.
Right.
Then there's Schedule A, but be very careful. It's specifically Schedule A, Form 1040-NR, for itemized deductions.
Not the regular Schedule A.
Not the regular one U.S. residents use. It's entirely separate, and the rules for what you can deduct on the non-resident version are much, much more limited.
Good to know.
And, of course, you have Schedule NEC, which is specifically for income not effectively connected with a U.S. trade or business.
Yes.
A concept we'll definitely deep dive into later.
Okay.
Finally, there's Schedule P for foreign partners who have certain interests in U.S. partnerships. So, yeah. If your return is more complicated, say you're claiming specific deductions or credits, or you have U.S. source income not effectively connected with the U.S. trade or business, you will almost certainly need one or more of these.
Seems like a lot to track.
It can be. The good news is if you use tax preparation software for e-filing, it typically helps determine which schedules are applicable to your unique situation. That can save you from sorting through piles of forms,
That makes perfect sense. It sounds like knowing which schedules to use is half the battle, and good tax software can be a lifesaver there. But speaking of critical distinctions, I know filing status is a massive deal for U.S. residents, impacting everything from tax brackets to standard deductions. Does that landscape change dramatically for non-resident aliens?
Oh, dramatically.
Yeah.
It's not just different. It's a key distinction and one that often surprises people used to U.S. resident filing conventions.
How so?
Unlike U.S. citizens and residents, a non-resident alien filing Form 1040-NR cannot choose married filing jointly or head of household filing statuses.
Cannot at all.
Cannot. This is a fundamental rule. If you're married as a non-resident alien, Your appropriate status is generally married filing separately.
Even if you live with your spouse.
Even if you are happily married and not physically separated from your spouse, yes.
Yeah.
The IRS views married non-resident aliens as separate individuals for tax purposes, unless a specific election is made to treat them as U.S. residents, which is a whole other topic. And this limitation has a ripple effect across your entire return. It impacts your tax rates, standard deduction amounts, many other potential benefits you might typically expect.
So the tax brackets are probably less favorable too.
Generally, yes. The brackets for married filing separately are usually less favorable than married filing jointly.
That's a huge one to be aware of. So if your filing status is restricted so significantly, I imagine that means access to common tax benefits that U.S. residents take for granted might also be severely limited or completely unavailable.
You're absolutely right to anticipate that.
What are some of the most popular credits or deductions that non-resident aliens generally can't claim?
Certain widely known U.S. tax benefits are either entirely unavailable or severely limited for non-resident aliens. For instance, the very popular child tax credit,
Right.
the credit for other dependents, and the additional child tax credit are generally not claimable by non-resident aliens.
Not at all.
Generally not. This is a critical point because expecting these credits, perhaps because you have qualifying children, could lead to a very different and probably unpleasant outcome on your tax bill.
So don't count on them.
Don't count on them. The premium tax credit, often used to help with health insurance costs, also falls under these limitations for dependents. So the key takeaway here is, don't assume U.S. resident benefits apply to you, especially family-related credits. Always check your specific situation, check any treaty first, or you could be in for a significant surprise.
But I seem to remember there being some exceptions to that rule, correct? Not everyone is excluded from those family-related benefits.
Correct. There are specific, very limited exceptions, which further highlights the importance of understanding your country of residence and any applicable treaties.
Okay, who gets the exception?
These particular benefits, child tax credit, etc., are available in full only to residents of Canada and Mexico.
Only Canada and Mexico.
For the full credit, yes. Additionally, they are available to a limited extent to residents of India and South Korea.
Limited extent.
Meaning they might get some benefit, but perhaps not the full amount, depending on the specific treaty details and rules.
Okay.
So this means if you're from, say, Europe, Asia, outside of India, South Korea, or South America, you generally cannot claim these credits no matter how many qualifying children you have.
So you really need to know your treaty status.
Absolutely. It's crucial to verify your specific situation. Also, it's worth noting that Form 1040-NR filers generally do not use forms like Form 2555, which deals with the foreign earned income exclusion.
Right, residents use that.
Exactly. Or Schedule K1, Form 1120-S, which is related to S corporation income. This is important because if you've previously dealt with S-corp income or foreign earned income as a resident, you'll find those specific pathways are closed off for non-residents.
It just underscores how different this tax world is.
It really does. You need to approach it from a non-resident perspective from
Okay.
day one.
It's clearly a whole different ballgame. Now, for those planning their taxes for the upcoming season, what's new for the 2024 tax year that they should be aware of, even if it's just a quick heads up on changes?
Okay, well, for most individuals who received wages subject to U.S. income tax withholding, the standard due date for filing Form 1040-NR for the 2024 tax year is April 15th, 2025.
Mark your calendars.
Definitely mark that on your calendar immediately. Beyond that, a couple of increases to be aware of. The exemption amount for qualified disability trusts has increased to $5,000 for 2024.
Okay, specific, but good for those it affects.
Right. While it might not apply to everyone, for those managing such trusts, it's a beneficial adjustment. And reinforcing what we just discussed about limitations, the maximum additional child tax credit amount has increased to $1,700 for each qualifying child.
Why?
But again, it's critical to remember those country-specific limitations still apply. Canada, Mexico, India, South Korea. So it's not a universal benefit for all non-resident aliens, even with the increase.
Got it. Still very restricted. All right, we've thoroughly laid the groundwork, understanding the fundamental differences. Now let's move to the part I know our listeners are truly eager for: strategic tax reduction.
Ah, yes.
This is where we uncover how to potentially save significant money through leveraging international treaties and making specific, powerful elections.
And what's truly fascinating and often overlooked here is that Tax treaties are arguably one of the most powerful tools available to non-resident aliens looking to reduce their U.S. tax liability.
More powerful than deductions sometimes.
Potentially, yes. These aren't just obscure legal documents. They're binding international agreements between the U.S. and other countries. They're designed to prevent double taxation and foster trade and investment.
And they override regular U.S. tax law.
They absolutely can. They can provide a reduced rate or even a complete exemption from U.S. withholding tax on certain types of income. So if you're entitled to a reduced rate or exemption under a treaty, the appropriate U.S. tax rate for that income is the specific treaty rate.
Which could be much lower.
Dramatically lower than the standard 30% flat rate that often applies by default, or even 0% in some cases.
So if someone's income was withheld at the higher standard 30% rate, but they're eligible for a lower treaty rate, they could actually get a refund. Can you give us a clear example of that?
Absolutely. Let's consider Alex. Alex is a non-resident alien whose only U.S. source income was dividend income from U.S. stocks.
Okay.
The financial institution may be unaware of Alex's specific treaty eligibility, or just applying the default rule, incorrectly withheld tax at 30% on those dividends.
Okay, pretty standard default.
Right. Now, let's say Alex's country of residence has a tax treaty with the U.S. that specifies a reduced dividend withholding rate of, say, 15%.
Half the rate.
Exactly. By correctly reporting this on Form 1040-NR and crucially citing the specific treaty article on Schedule OI.
That's the other information schedule again?
Yes, and attaching Form 8833. Think of Form 8833 as your official letter to the IRS saying, hey, I'm using a treaty, here's how and why. Alex would be eligible for a refund of that 15% over withheld amount.
Wow. So just knowing the treaty rate isn't enough, you have to claim it properly.
You absolutely have to claim it properly. This highlights the critical need to be proactive and aware of your treaty benefits, even if the withholding agent didn't apply them correctly initially.
That's a concrete example of money literally being left on the table if you don't know your rights and how to claim them. What about a situation where income is completely exempt by treaty? That sounds even better.
It is. Let's look at Dale. Dale is a non-resident alien who receives several dividend payments and multiple interest payments, all reported on a Form 1042-S.
That's the form for income subject to withholding, right?
Correct. For the interest payments, a relevant tax treaty between Dale's country of residence and the U.S. provided a complete exemption from U.S. tax on that specific type of interest income.
Complete exemption, zero tax.
Zero tax. In Dale's case, these interest payments didn't need to be reported on the main lines of Form 1040-NR at all, or if they were, they'd be listed on Line 1K as treaty-exempt income because they were entirely exempt by treaty.
Line 1K, okay.
This demonstrates the potential for complete exemption, not just a reduced rate, meaning zero U.S. tax on that income.
Where do people find these treaties?
My strongest advice for anyone in this situation is to check the irs.gov website directly. It provides the complete texts of all U.S. tax treaties. That's your go-to authoritative resource for verifying these specific benefits. Don't rely on assumptions or summaries.
Go to the source, irs.gov. That's incredibly powerful. But what about individuals who might technically be considered residents of both the U.S. and another country? That sounds like a recipe for a double taxation nightmare.
It definitely can be. This brings us to the concept of dual resident taxpayers, which is a common scenario for people who spend significant time in both countries.
How does that work?
You're a dual resident taxpayer if you meet the residency test for both the United States and a foreign country under each country's respective tax laws. So maybe you meet this substantial presence test in the U.S., but are also considered a resident under your home country's laws.
Right, taxed everywhere.
That's the risk. But the significant tax-saving opportunity here lies in income tax treaties that contain what are known as tiebreaker rules.
Tiebreaker rules? Like in sports?
Sort of. These rules act like a flowchart, using factors like where your permanent home is, where your economic and personal ties are closer, where you habitually live, or your citizenship, to determine which country you are primarily a resident of for tax treaty purposes, even if both countries initially claim you as a resident.
So the treaty decides where you belong for tax.
Exactly. If, under these tiebreaker rules, you determine you're a resident of the foreign country, you can then elect to be treated as a non-resident of the United States for income tax purposes.
How do you make that election?
You file Form 1040-NR, the non-resident return, and crucially, attach Form 8833, the treaty-based return position disclosure.
That form again?
Yes, it's key for treaty claims. This simple act can dramatically alter your U.S. tax obligations, often reducing them substantially, by allowing you to avoid being taxed as a U.S. resident on your worldwide income.
Huge. Otherwise, the U.S. could tax your global income.
Potentially, yes. Without this election, you could face being taxed by the U.S. on all your income, regardless of where it was earned, in addition to being taxed by your home country. Double taxation.
That's a genuine game changer for someone in that situation.
Yeah.
Another area that often generates income for non-residents is U.S. real property, especially rental income. How is that typically taxed, and are there any strategic elections that can reduce the tax burdens significantly?
Excellent point, and this is a very common area for potential substantial savings. Generally, income from U.S. real property, like rent from a property you own in the U.S., is taxed at a flat 30% or a lower treaty rate.
Flat 30% on the gross rent.
Typically, yes. This is because it's considered income not effectively connected with a U.S. trade or business, essentially, passive income.
And the drawback.
The significant drawback here is that no deductions are allowed against this income when it's taxed that way.
No deductions at all, not even mortgage interest or property taxes.
Nope. Even if you have substantial expenses, like mortgage interest, property taxes, maintenance, repairs, or depreciation, you cannot subtract them from your gross rental income to reduce your taxable amount under that flat 30% regime.
Ouch. So you could have a tiny profit but pay tax on the whole rent.
Exactly. Imagine paying 30% on $100,000 of gross rental income, even if your actual profit after expenses is only $10,000. That's $30,000 in tax on a $10,000 profit. That's the trap this rule can create.
And that's where the election comes in, right? This is where it gets really interesting for real estate investors.
Exactly. This is where the critical election under Section 871D comes into play. You can choose to treat your income from U.S. real property as effectively connected with a U.S. trade or business.
Okay, so you're basically saying treat this like a business.
Precisely. The reason this is such a powerful tax-saving strategy is that by making this election, the income is then taxed at the same graduated rates that apply to U.S. citizens and residents.
Graduated rates, not the flat 30%.
Right. And crucially, this means you can now claim legitimate deductions related to that income, all those expenses we mentioned. Yeah. Depreciation, property management fees, mortgage interest, property taxes, utilities, repairs.
Ah, so you get taxed on the net profit, not the gross income.
Exactly. This could result in a much, much lower effective tax rate. In our example, instead of paying 30% on $30,000 tax, you might pay graduated rates on $10,000 of net profit, potentially reducing your tax bill to just a few $1,000s or even less.
That is a massive difference.
It transforms passive, high-taxed income into active, lower-tax income, allowing you to treat your rental property like a legitimate business for tax purposes.
Truly optimizing your financial position. How does someone actually make this election? Is it complicated? Is it a yearly burden?
It's not too bad. To make this election, you attach a specific statement to your tax return for the first year you want the election to begin.
A statement, not a specific form number.
Usually a statement you write yourself, detailing certain things. It needs to include specific information about the property, like a complete list of all your U.S. real property, its location, the extent of your ownership, and a description of any substantial improvements.
Okay, you need to be thorough.
Yes. And what's even better is that this election, once made, remains effective for all future tax years unless you specifically revoke it.
So it's a one-time decision, mostly.
It's a one-time strategic decision with potentially long-term benefits, not something you have to redo every single year.
So we've covered real property, but what about employees, especially high earners, who might perform services both in and out of the U.S.? Are there ways for them to strategically source their compensation to minimize their U.S. tax liability?
Yes, there are. For employees, the general rule for compensation for services performed partly within and partly outside the U.S. is sourced on a time basis.
Time basis, like days worked.
Exactly. You determine the U.S. portion of your compensation by taking the number of days you worked in the U.S. and dividing it by the total number of days you performed services globally, then multiplying that fraction by your total compensation.
Simple ratio.
Pretty straightforward. Fringe benefits are generally sourced geographically based on your principal place of work.
Okay. But you mentioned high earners.
Right. Here's where it gets really interesting and offers significant strategic opportunity for high earners. If your total compensation, including fringe benefits, is $250,000 or more.
$250,000 threshold.
Yes. If you meet that, you may be able to use an alternative method to allocate your compensation if it more properly determines the source.
An alternative method. That sounds like a significant opportunity to fine-tune income allocation and potentially reduce U.S.-sourced income. How do you go about doing that?
You check the yes boxes in Item K of Schedule OI, Form 1040-NR.
Schedule OI again. Lots happening there.
Central, and you attach a detailed statement to your Form 1040-NR. This statement needs to be very specific.
What does it need to show?
It needs to include the specific compensation or fringe benefit you're allocating differently, the exact alternative method used, a computation showing how it was calculated, and crucially, a comparison of the dollar amount sourced within and outside the U.S. under both the alternative method and the standard time or geographical method.
So you have to justify it clearly. What makes a method more proper?
That's subjective, but generally it means it more accurately reflects where the economic value of your services was generated.
Can you give an example?
Sure. Let's say you're a consultant, and a large chunk of your bonus is tied to closing a specific deal or hitting a project milestone while you were physically outside the U.S., even if you spent some time in the U.S. on related meetings.
Right.
An alternative method could argue that more of that specific bonus income should be sourced internationally based on where the key value-creating activity occurred, rather than just using a simple day count.
So it allows for a more nuanced allocation.
Exactly. A much more precise, a potentially beneficial allocation of income, which could reduce your U.S.-sourced income and thus your U.S. tax liability, provided you have clear documentation and a strong rationale to support your method.
That's a sophisticated strategy for high earners, definitely requiring careful documentation. What about income that is just completely exempt because of a treaty? We touched on Dale's interest income, but how is that handled generally on the return?
If certain income is entirely exempt from U.S. tax by an income tax treaty, whether it's effectively connected income or not effectively connected income, it must be reported on Line 1K of Form 1040-NR.
Line 1K, the designated spot.
That's the spot for treaty-exempt income. Crucially, this income should not be included on any other income line of the Form 1040-NR.
Don't double report it.
Right. You also need to fully disclose this exempt income in Item L of Schedule OI.
Schedule OI, Item L.
Got it. There you provide the specific treaty country and the article and paragraph that supports the exemption. And, if required, you must attach Form 1042-S, which you'd get from the payer, and Form 8833, the treaty disclosure form.
So full transparency is key.
Absolutely. This ensures complete transparency to the IRS while properly claiming your full exemption. Without this proper disclosure, the IRS might question the exclusion later.
And are there any specific types of interest income that non-residents might find entirely exempt, maybe even without relying on a treaty?
Yes, this is an important one that's often overlooked, and it applies broadly. Interest from U.S. banks, savings and loan associations, credit unions, or certain deposits with U.S. insurance companies.
So standard bank interest, basically.
Pretty much. It may be entirely exempt from tax under Section 871I of the tax code, even if your country doesn't have a specific tax treaty, provided that this interest is not effectively connected with a U.S. trade or business.
Ah, the not effectively connected rule again.
Exactly. So if you're just holding passive investments, like money in a typical U.S. bank savings account or certificate of deposit, CD, the interest earned on those deposits is generally not subject to U.S. tax.
That's huge for people parking money in the U.S.
It's a crucial exemption for many non-resident aliens with U.S. financial assets. It prevents unnecessary taxation on common passive income. It's essentially the U.S. trying to encourage foreign investment in its financial institutions.
Okay, that's a comprehensive look at strategic tax reductions through treaties and elections. Let's shift gears now to deductions, credits, and some other special income rules that apply to non-residents. This is another area where significant savings can be found, but with very specific caveats, right?
Indeed. Navigating itemized deductions on Schedule A, Form 1040-NR, has very specific rules for non-resident aliens that differ significantly from those for U.S. residents.
Schedule A, Form 1040-NR, the special one.
Right. One common deduction for U.S. residents is for state and local income taxes, or SALT. For non-resident aliens, you can deduct state and local income taxes paid or withheld, but only on income that is connected with a U.S. trade or business.
Only on the effectively connected income. So not state taxes paid on passive investment income, for instance.
Generally, no. It has to be connected with a U.S. trade or business, meaning it relates to your active participation in the U.S. economy, like U.S. employment or an active business you run here.
And is there a limit like there is for U.S. residents, the SALT cap?
Yes, the deduction for state and local taxes is generally limited to $10,000 or $5,000 if you're married filing separately.
Which is the common status for non-resident.
Exactly. So effectively $5,000 for many married non-resident aliens claiming this.
Okay. What about that safe harbor you mentioned in the outline? Something about charitable...
Ah, yes. That's a bit nuanced. There's a specific safe harbor rule. If you made a charitable contribution in exchange for a state or local income tax credit, and your charitable deduction had to be reduced because of that credit.
Like, you donated $5,000 and got a $1,000 state credit back?
Exactly. The IRS might say your charitable deduction is only $4,000 in that case. However, under this safe harbor, you might be able to treat some or all of that disallowed $1,000 charitable contribution as a payment of state and local income taxes instead.
So you could potentially deduct it under the SALT limit?
Potentially, yes. It
Yeah.
could allow you to effectively recover some of that benefit as a SALT deduction up to the overall $10,000, $5,000 limit. It's complex, but it can be beneficial in states with those types of contribution for credit programs.
That's a nuanced point that could really save some money. Moving on to charitable giving itself, what are the general rules for non-resident aliens donating to U.S. charities? Can they deduct those?
Yes, gifts to U.S. charities are generally deductible, which is great news for those who are philanthropic. You could deduct contributions or gifts you gave to qualified U.S. organizations.
U.S. organizations specifically.
Yes, they need to be U.S. religious, charitable, educational, scientific, or literary organizations. Typically, organizations recognized by the IRS as 501c3 public charities.
What counts as a contribution? Cash, property.
All of the above. Cash, checks, property,
Yeah.
even your out-of-pocket expenses for volunteer work. Like the instructions mention 14 cents per mile if you drove your car for charitable purposes in 2024.
Okay. What about if you get something back, like dinner tickets?
Good question. If you receive a tangible benefit in return for your gift-like tickets to an event or merchandise, you can generally only deduct the amount that's more than the fair market value of that benefit.
Makes sense. Any record-keeping requirement.
Absolutely. For gifts of $250 or more, you must have a contemporaneous written acknowledgement from the charity.
Contemporaneous? Meaning?
Meaning you get it around the time you make the donation. It needs to detail the contribution amount, state whether you received any goods or services in return, and describe them if you did. And you need this acknowledgement by the time you file your return. No receipt, potentially no deduction for larger gifts.
Strict documentation. Are there limits on how much you can deduct for charitable contributions? And are there types of gifts you can't deduct that might surprise someone?
Yes, there are limits. They're based on a percentage of your adjusted gross income, AGI, from Form 1040 NR, line 11. For cash contributions, it's generally limited to 30% of that AGI.
30%, lower than for residents, I think.
Yes, residents often have higher limits, like 60% for cash. For capital gain property, like appreciated stock or real estate held over a year, the limit for non-residents is generally 20% of AGI.
Okay, 30% and 20%. What can't you deduct?
Several important exclusions. You cannot deduct the value of your time or services. Volunteer hours aren't deductible. You also can't deduct gifts to specific individuals, no matter how needy, or gifts to groups operated for personal profit, or political contributions, or dues to social clubs, or the cost of raffle or lottery tickets, unless maybe as gambling losses, which we'll get to.
And the big one, foreign charities.
That's a huge one. Generally, you cannot deduct gifts made directly to foreign organizations on your U.S. return.
So donating to a charity back home doesn't count for U.S. taxes?
Typically not. There are very limited exceptions for gifts to certain U.S. organizations that transfer funds to foreign charities and some specific Canadian, Israeli, and Mexican charities under their respective treaties, but the general rule is direct donation to a foreign charity is a no-go for U.S. deduction purposes.
Very important distinction. Speaking of gambling, how are gambling losses handled for non-residents? I imagine that's an area with very specific and often counterintuitive rules.
You're absolutely right. This is an area where knowing the specific rules is paramount, especially with treaties involved. Generally, gambling losses are deductible only to the extent of your gambling winnings reported on Schedule 1, Form 1040, line AB.
Okay. Losses offset winnings.
Up to the amount of winnings, yes. However, this income, the winnings and the losses, must be effectively connected with a U.S. trade or business.
Ah, there it is again. Effectively connected.
Yes, this is a very strict limitation. It means most casual gamblers, people just visiting Vegas for fun, likely won't meet this effectively connected criteria for their gambling activities. The gambling isn't typically considered a U.S. trade or business.
So most casual gamblers can't deduct losses.
Generally not under this rule. We'll
But
talk about treaty exceptions in a moment, but the default is often no loss deduction for casual gambling.
what about casualty and theft losses? Are those deductible?
Very limited now. Generally, personal casualty and theft losses are deductible only if they are attributable to a federally declared disaster.
Only federal disasters, like hurricanes or major floods.
Exactly. And even then, they're subject to thresholds. You reduce each loss by $100, and then the total net loss is only deductible to the extent it exceeds 10% of your adjusted gross income from Form 1040 NR, line 11.
High hurdles.
Very high. There's a small exception if you have personal casualty gains not from a disaster. You might be able to deduct non-disaster losses up to the amount of those gains, but it's quite specific.
That's very specific indeed. So most non-residents won't be deducting gambling or casualty losses easily. Now, moving beyond itemized deductions, are there any targeted credits or common deductions that Form 1040 NR filers can definitely look out for and claim?
Absolutely, there are a few bright spots. Two good ones to highlight are the clean vehicle credits.
For electric cars?
Yes, for qualifying electric or plug-in hybrid vehicles. Both the credit for new clean vehicles and the credit for previously owned clean vehicles are available for Form 1040 NR filers.
How do you claim those?
You report these on Form 8936, the Clean Vehicle Credits form, and then you transfer the credit amount to Schedule 3, which summarizes additional credits. This is a concrete opportunity for those who might be purchasing qualifying vehicles while in the U.S.
Good to know. Any others?
There's a unique opportunity, though highly specific: the Qualified Charitable Distribution One-Time Election. If you're 70 and a half or older, you can elect to make a one-time distribution of up to $53,000 from an individual retirement account, IRA, directly to charities through specific split-interest entities like charitable remainder trusts or charitable gift annuities.
Very specific, but powerful for the right person.
Yes, and for self-employed individuals, the self-employed health insurance deduction is available, which you figured using Form 7206. So yes, there are definitely some valuable deductions and credits available beyond the standard itemized ones.
That's great for those specific situations. Let's delve back into gambling winnings for a moment, because I know the rules can be incredibly complex, especially depending on your country of residence and the type of game.
This is a prime example of where treaty benefits can be crucial and where a tiny detail in the rules can mean a significant refund. Let's start with residents of Canada.
Okay, Canada.
If you're a resident of Canada and you're not engaged in the trade or business of gambling, meaning it's just a hobby, not your profession.
Casual gambler from Canada.
Right. You report all your U.S. gambling winnings on Schedule NEC, Form 1040 NR. That's the schedule for income not effectively connected. And here's the key benefit. Under the U.S.-Canada Treaty, you can deduct your U.S. source gambling losses to the extent of your U.S. source gambling winnings.
Ah, so Canadians get to offset losses against winnings, even if it's not effectively connected.
Exactly. This is a massive advantage provided by the treaty, letting you reduce your taxable winnings significantly, maybe even to zero, if losses equal or exceed winnings.
That's huge compared to the general rule.
It is. However, and this is a crucial carve-out in the instructions, this specific benefit for Canadians excludes winnings from certain games: blackjack, baccarat, craps, roulette, or big six-wheel.
Wait, why exclude those specific table games?
Because those specific games have different, often even more favorable rules under a separate provision, which we'll get to. But for general gambling like poker or slots, Canadians can offset losses against wins thanks to the treaty.
Okay, so Canadians get a break on most games, offsetting losses.
Yeah.
What about residents of other treaty countries or those without a treaty? How do their gambling winnings shake out?
For residents of other countries that have a tax treaty with the U.S., your gambling winnings may be entirely exempt by treaty.
Completely exempt.
Possibly. It depends entirely on the specific wording of that country's treaty. If they are exempt, you report these winnings on Schedule NEC, but specify a 0% tax rate.
So, again, knowing your treaty is key.
Absolutely paramount. The onus is on you to know the specific terms. Now, for residents of countries without a tax treaty, or where the treaty doesn't provide an exemption for gambling,
What happens then?
you must report all your gambling winnings, typically subject to that flat 30% withholding rate on Schedule NEC. And the major difference here, compared to Canadians, is that you cannot offset losses against winnings unless those winnings and losses are from the exact same session of play.
Same session. What does that mean?
It generally means the same continuous period of gambling at the same table or machine. So if you win $1,000 in one poker game in the afternoon and lose $1,000 in another poker game later that evening, even on the same day,
Different sessions.
likely considered different sessions. If so, you still owe tax on the $1,000 win, with no offset for the $1,000 loss from the later session. This same session rule is very restrictive for non-treaty residents.
Wow, that makes a huge difference in taxable income.
Absolutely. It prevents netting wins and losses over a trip or even a day for most people.
Okay, now back to those specific games you mentioned, blackjack, baccarat, craps, roulette, or big six wheel. You said they had even more favorable rules. Is there a refund opportunity if tax was already withheld?
This is an important refund opportunity that many, many people miss. For winning specifically from blackjack, baccarat, craps, roulette, or big six wheel.
The classic casino table games.
Exactly. If a U.S. casino withheld tax on those winnings and provided you with a Form 1042-S showing the withholding,
Which they often do.
yes, you enter these winnings on Schedule NEC, but you enter them at a 0% tax rate. And here's the best part. You can claim a refund of the tax that was withheld.
Even if you're from a non-treaty country.
Yes, even if you're from a non-treaty country. Winnings from these specific games are explicitly exempted from U.S. tax for non-resident aliens under a specific code section, separate from treaty benefits.
That's amazing. So knowing this distinction for those specific games can literally put withheld money back in your pocket.
It absolutely can.
Okay.
Always check your Form 1042-S carefully. If the income code relates to these games and tax was withheld, you likely have a refund coming if you file correctly.
Fascinating. So many nuances that can make a real financial difference. Now, circling back to common deductions like IRA contributions or educator expenses, how do those apply to non-resident aliens? Are there any exceptions to what U.S. residents might expect?
There definitely are exceptions, and it often comes down to that concept of effectively connected income again.
Always back to ECI.
Pretty much. For the IRA deduction, while generally available in principle, Form 1040-NR filers have very strict limitations. First, you cannot use your spouse's earned income or alimony received when calculating your potential IRA deduction.
Okay, only your own income counts.
Your own earned income, and more critically, to take this deduction at all, you must have taxable compensation that is effectively connected with a U.S. trade or business.
So if your only U.S. income is passive, like dividends or that exempt bank interest,
Then you generally won't qualify for an IRA deduction based on that income. Your eligibility hinges on having U.S. work income or active business income.
got it.
Furthermore, any discussions around Form 2555, the foreign earned income exclusion, are irrelevant here. Non-resident aliens cannot file Form 2555.
Right, separate rules. What about educator expenses?
Similarly, for educator expenses that small deduction teachers can sometimes take for classroom supplies, these must be related to your effectively connected income to be deductible on Form 1040-NR.
So if you're a teacher working in the U.S. and that's your effectively connected income,
Then your qualifying educator expenses could potentially be deductible up to the limit. But if you're a teacher abroad with no U.S. ECI, then no deduction.
got it. So it almost always comes back to whether the income or the expense relates to being effectively connected. What about non-taxable income for non-residents? Are there certain types of income they don't even need to worry about reporting or paying tax on?
Yes, this is another area where understanding the rules can save you from over-reporting and paying tax unnecessarily. For instance, gifts or bequests received from a foreign person are generally not taxable income in the U.S., regardless of the amount.
So if family abroad sends money or leaves an inheritance,
It's typically not U.S. taxable income to you as the recipient. Many people assume large gifts are always taxable, but that's often a U.S. donor rule, not a recipient rule, especially when the gift comes from foreign sources to a non-resident alien.
good to clarify. Any others?
Also, as we touched on earlier with Dale's example in the Section 871S exemption, certain interest from U.S. banks, savings and loans, credit unions, or certain U.S. insurance company deposits, if it's not effectively connected to a U.S. trade or business.
It's generally tax exempt.
It's generally tax exempt, either under that code section or potentially a tax treaty. This is a crucial exemption often overlooked, leading some to mistakenly report and pay tax on income that is actually exempt under U.S. law.
This has been incredibly insightful for understanding the intricacies of non-resident alien taxation and where the biggest opportunities lie. Now let's move to the practical side, navigating the filing process itself, and crucially, where to find essential support when you need it most.
Right. And a core foundational concept to really grasp when filing as a non-resident alien is that critical distinction between income effectively connected with a U.S. trade or business, ECI,
Mhm.
and income not effectively connected with the U.S. trade or business, an ECI.
ECI versus NECI.
This is fundamental to how all your U.S. income is taxed. Think of ECI as income from your active business efforts or employment within the U.S. income, where you're directly participating in the U.S. economy.
Like wages or profits from a business you run here.
Exactly. This ECI is taxed at the same graduated rates that apply to U.S. citizens and residents. And crucially, it allows you to claim deductions related to that income, business expenses, state income taxes related to it, etc.
Okay, graduated rates, deductions allowed. What about NCR?
An ECI, on the other hand, is generally passive income. Things like dividends, most interest unless exempt, royalties, certain rental income if you didn't make that 871J election we talked about.
The passive stuff.
Right. This income is generally subject to a flat 30% rate, or a lower treaty rate if one applies. And the key difference, against this income, no deductions are allowed.
Flat rate, no deductions. Big difference.
Huge difference. And these two categories are reported on different parts of the Form 1040-NR or on specific schedules like Schedule NEC for the NECI income. Misclassifying income can lead to a drastically different tax outcome.
So it's not just about what kind of income you have, but also how it's classified, which then fundamentally determines how it's taxed and what deductions you can take. Are there specific types of income that almost always fall under NECI that listeners should be aware of?
Yes, definitely. For example, 85% of any U.S. Social Security benefits you might receive are specifically treated as NECI.
85% of Social Security is NECI.
Okay? Also, certain alimony payments you receive from a U.S. source are generally classified as NECI. It's vital to correctly categorize your income to ensure you're applying the right tax rates and not missing out on deductions for your ECI.
This ECI distinction sounds like a major potential pitfall.
It's one of the most common areas of error for non-resident aliens, absolutely. So it really bears repeated emphasis.
When it comes to actually submitting these forms, what are the modern benefits of e-filing, and how do electronic payments work, especially for non-residents who might have unique banking situations?
Well, IRS e-file is really the standard now, not the exception, especially for most paid tax preparers. And there are compelling advantages.
Like what? Beyond just maybe being faster?
Well, speed is one,
Yeah.
especially for refunds, but also enhanced security through the latest encryption technology protecting your sensitive data. Flexible payment options, you can e-file early, but schedule your payment closer to the April 15th due date.
Aha, file now, pay later.
Exactly. E-filing dramatically leads to greater accuracy because the software catches common errors and calculation mistakes, which means faster processing overall. You get a quick electronic receipt confirmation almost instantly, giving you peace of mind.
No wondering if the mail got lost.
Right. It's also environmentally friendly, less paper. And most importantly for many, e-file combined with direct deposit leads to significantly faster refunds. 8 out of 10 taxpayers get their refunds quicker this way, often in less than 21 days.
That sounds incredibly convenient and secure. What are the options for making payments electronically, especially for those who might not have a U.S. bank account readily available?
You have several reliable ways to pay your U.S. taxes online. There's IRS Direct, pay a free service, letting you pay directly from a U.S. checking or savings account.
Okay, needs a U.S. account, though.
Yes. You can also use debit or credit cards through approved third-party processors, though these usually involve a small fee from the processor.
Convenience fee.
Right. There's also electronic funds withdrawal when you e-file using tax software. You authorize the payment directly when you submit your return, again, usually from a U.S. bank account. For businesses, the Electronic Federal Tax Payment System, EFTPS, is the best option, but it requires prior enrollment.
So what if you don't have a U.S. bank account?
That's a key question for many international filers. The IRS provides specific guidance for this. If you want to pay electronically without a U.S. bank account, you should check out the page. irs.gov Individuals International Taxpayers Foreign Electronic Payments. They list options that might work, like international wire transfers through your bank.
Good resource. And payment has to be in U.S. dollars, right?
Absolutely critical. All payments of U.S. tax must be remitted in U.S. dollars. Digital assets like cryptocurrency are not accepted for tax payments.
Given the complexity we've discussed, I can imagine some returns are much more involved, especially for those with business interests in U.S. partnerships. What happens when a non-resident alien is a foreign partner in a U.S. partnership? Is there a special schedule?
Yes, there is. If you're a foreign partner who transferred interest in a partnership that was engaged in a U.S. trade or business, or one holding U.S. real property interests, you'll need to understand and potentially file Schedule P, Form 1040-NR.
Schedule P for partnership interests.
Exactly. This specific schedule is designed to report gains or losses from such transfers of partnership interests. Crucially, these gains or losses are generally treated as effectively connected income.
ECI again. So graduated rates apply.
Yes, meaning they are taxed at graduated rates and allow for related deductions, if any. Schedule P uses information from Schedule K3, Form 1065, which you should receive from the partnership itself, to help you calculate and correctly report these amounts.
So you need that K3 from the partnership.
Absolutely. It's a vital part of ensuring accurate reporting for foreign partners, especially given the strict rules around partnership interests and U.S. business activities.
This is a lot of information, and it can certainly feel overwhelming, even for the most well-informed listener. What if someone encounters a problem they can't resolve on their own or just needs help understanding something specific? What crucial resources are available?
This brings us to some absolutely crucial support systems that are designed to help taxpayers navigate these very complexities. First, there's the Taxpayer Advocate Service, or TAS.
TAS, what's special about them?
What's fascinating and incredibly important here is that TAS is an independent organization within the IRS.
Independent within the IRS, how does that work?
Their sole job is to help taxpayers and protect taxpayer rights. They are separate from the enforcement arms of the IRS. They are there to assist you if your tax problem is causing a significant financial difficulty.
Like you can't pay rent or something.
Exactly, like you can't pay essential bills, you're facing eviction, things like that.
Yeah.
Or if you've tried and failed to resolve an issue directly with the IRS through normal channels and you're just hitting a brick wall.
Okay.
Or, importantly, if you believe an IRS system, process, or procedure just isn't working as it should and it's causing you undue burden.
And their help is free.
Their service is entirely free. They act as your advocate within the IRS system to help get your problem resolved fairly.
That's a powerful safety net for when you hit a wall. How can listeners get in touch with TAS?
You can find your local advocate's number and office location by going to taxpayeradvocate.irs.gov, contact us. Or you can download IRS Publication 1546, which has information. You can also call them toll-free at 877-777-4778.
877-777-4778. Good number to know.
They have offices in every state, the District of Columbia, and Puerto Rico, so help is generally accessible.
And are there resources for those with lower incomes or who might need help in other languages, perhaps with audits or collection disputes?
Absolutely. That's where low-income taxpayer clinics, or LITCs, come in. These are another invaluable resource.
Are they part of the IRS too?
No, importantly, LITCs are independent from both the IRS and TS. They receive some funding from the IRS, but they are run by nonprofits, law schools, accounting firms, etc.
Okay, completely separate. What do they do?
LITCs represent individuals whose income is below a certain threshold, typically 200 to 50% of the federal poverty line, though it can vary slightly by clinic. They help people who need to resolve tax problems with the IRS, like audits, appeals, collection disputes, correcting account issues.
So direct representation in disputes.
Yes. They can also provide comprehensive information about taxpayer rights and responsibilities in multiple languages for individuals who speak English as a second language, ESL taxpayers.
Is their service free?
Services are often offered for free or for a very small fee, depending on the clinic and a taxpayer's income level.
How do you find an LITC?
You can find an LITC near you by visiting the TS website again at taxpayeradvocate.irs.gov LITC map, or by checking IRS Publication 4134, which lists LITCs by state.
It sounds like there's a robust support system designed to help, which is reassuring given the complexity we've discussed. What about knowing your basic rights as a taxpayer when dealing with the IRS? Does that help?
It definitely does. This raises an important question. What exactly are your fundamental rights when interacting with the IRS? The IRS has published the Taxpayer Bill of Rights.
The Bill of Rights for taxpayers.
Yes. It clearly outlines 10 fundamental rights that all taxpayers have. These include things like the right to be informed about the tax laws and IRS procedures, the right to quality service from IRS employees, the right to pay no more than the correct amount of tax.
That sounds like a good one.
It is. And the right to challenge the IRS's position and be heard. the right to appeal an IRS decision in an independent forum, the right to finality, the right to privacy, the right to confidentiality, the right to retain representation if you choose.
So you have the right to hire someone.
Absolutely. And the right to a fair and just tax system. Knowing these rights empowers you in your dealings with the IRS, ensures you are treated fairly, and helps you understand what you're entitled to during any interaction.
Where can people see these rights?
You can learn more at irs.gov. Taxpayer rights is worth reading through.
And finally, a quick mention of something that can protect you against a very real modern threat: identity theft.
Yes, the Identity Protection PN, or IKPIN, is a critical preventative measure against tax-related identity theft and the fraudulent misuse of your Social Security number, or ITN.
How does it work?
It's a 6-digit number assigned only to you by the IRS. When you have an IPPIN, it acts as a secret key. It prevents someone else from filing a fraudulent tax return using your SSN or ITIN because that fraudulent return would be rejected by the IRS e-file system if it doesn't include your unique current year IPPIN.
So it stops fake returns before they're processed.
Exactly. It adds an extra layer of security to your tax filing. You can learn more about how to get one if you're eligible at irs.go/IPPIN.
And of course, keeping good records and knowing how to amend a return are always foundational for any tax situation, right? Non-resident or not.
Without a doubt, retaining your records, all your income statements like Form 1042-S, any W-2s, 1099s, all your deduction receipts, foreign tax documents, copies of past returns is absolutely critical, especially for non-resident aliens who often have complex income sourcing and treaty claims to support.
How long should you keep records?
Generally, at least 3 years from the date you file the return or the due date, whichever's later. Longer in some cases, like if you understated income significantly, or for records related to property.
And what if you make a mistake and need to fix a past return?
If you need to amend a Form 1040-NR for tax year 2022 or a later year, you can now e-file Form 1040-X, which is the amended U.S. individual income tax return.
Ah, you can e-file amendments now. That's newish, right?
Relatively new, yes.
Yeah.
Previously, amended returns generally had to be mailed in on paper, which was slower. E-filing Form 1040-X is a welcome convenience.
Can you track its status?
Yes, you can check the status of your amended return online at irs.gov WMAR. That stands for Where's My Amended Return?
Good tool. How long does it take?
Be prepared for some waiting, though. The website says it can take up to 3 weeks just for your amended return to show up in their tracking system, and often up to 16 weeks, sometimes longer, for it to be fully processed. So patience is definitely key when amending.
16 weeks or more? Wow. Okay. Well, today we've really peeled back the layers of U.S. tax instructions for non-resident aliens, haven't we? Uncovering critical distinctions and, I think, some significant opportunities for tax savings.
Absolutely. From leveraging powerful tax treaties, like getting lower rates on dividends or exempting certain interests, to making strategic elections, like treating U.S. real property income as effectively connected. Understanding these nuances isn't just about compliance.
It's about optimizing your financial position.
Exactly. It's about ensuring you're not paying $1 more than you legally owe.
We've seen how specific provisions like that tiebreaker rule for dual residence or the ability to deduct expenses against effectively connected real property income can dramatically reduce your U.S. tax burden.
Yeah, the differences from standard U.S. resident filing are profound. Recognizing them is the absolute first step toward effective tax planning and really financial empowerment as a non-resident dealing with the U.S. system.
Every line on these forms, every schedule, every publication holds the potential for either a missed opportunity or a significant strategic advantage.
It truly is about being informed and proactive. You can't just assume the rules are the same as for residents or even the same as in your home country.
The U.S. tax system, particularly for non-residents, can seem daunting. A complex maze of rules, forms, exceptions.
It certainly can feel that way.
Yet it's built on a framework of rules, exceptions, and specific provisions designed, at least in theory, to address diverse international circumstances like yours. The provocative thought we want to leave you with is this. Are you simply submitting your forms, maybe using software, hoping for the best?
No.
Or are you actively engaging with the possibilities within these rules? Are you looking for those treaty benefits, those elections, those specific deduction rules to ensure you're not leaving any eligible legal tax savings on the table?
Remember, knowledge is power, especially when it comes to your money. This isn't just about avoiding penalties or audits. It's about potentially reclaiming money that was over-withheld or structuring things correctly going forward to minimize future tax legally. It's about ensuring your financial well-being within the U.S. tax framework.
We strongly encourage you to revisit your tax situation with these insights in mind. Look up your country's treaty on irs.gov. Check those specific rules for gambling or real estate if they apply to you. Consult the IRS resources we mentioned, like TAS or the LITC map.
Or, very importantly, consider seeking professional advice from a qualified tax professional who specializes in non-resident alien taxation. They live and breathe these specific rules every day.
Make sure you're harnessing every legal advantage available to you. Your financial well-being is absolutely worth the deep dive.